March, and we actually saw the highest intraday level that we've seen for the market since the 10th of June 2008. But we did end the day down by 1 point, and that means we have broken that 6-day winning streak that we've seen for the Aussie share market. I think the biggest thing on the Australian market today was the battle that we saw between the banks and the material space. The banks were well supported, and that's really on expectations that we are going to see higher earnings and higher dividends coming through with the earnings season. On Thursday, we'll see ANZ coming out with half-year numbers. On Friday, we'll be watching Macquarie's full-year numbers. And then next week, on Monday, we'll see Westpac. And then on Thursday, we'll see NAB. So the banks will support it ahead of those earnings, as well as the ex-dividend dates that do happen in May. But the material sector down by 0.8%. We saw iron ore prices down by 1.9%. And China's Shanghai Composite down for the 4th consecutive day as optimism around stimulus actually disappears from the market. So the market starting to price out stimulus from China. We saw stocks like Atlas Iron down by more than 5%, Fortescue down by more than 4%, and BC Iron down more than 3%. But the gold miners did do well in that space. And then secondly, the healthcare space also a negative impact on the market, and that was mainly due to Acrux, which was down another massive 33% today. It was the worst performer in the ASX 200. Lastly, it's going to be a big week, and we'll be watching not only the banks here domestically, but overseas. It's going to be huge in the US. We see the US GDP numbers, where we're expecting to see annualized GDP slow down to 1.3% from 2.6%. We see the FOMC meeting and the non-farm payroll numbers. So a slow start to the week on the Aussie share market, but it's going to be a big one this week.
The three banks that report this week, but still, I mean, do you think it'll be enough to justify the price that we're seeing some of these banks trading at?
I think if you have to look at the price and the growth that the bank shares have seen in the last couple of years, it's really been driven by the lower interest rates that we've been seeing here in Australia. When you see banks growing in single digits, but bank share prices growing in double-digit territory, you know that there has been a bit of a disconnect, and it's really because of the lack of interest rates available around the world, with the US as well as Japan offering zero interest rate policies since the global financial crisis. So I think that's been a key driver of the banks. I think as we start to see interest rates starting to rise in Australia, that's probably the biggest threat to the bank's share price action, because it is those high yielding areas like the bank's utilities, telecom sectors, which have done well because of their high yields throughout the last 3 to 5 years since the global financial crisis. So I think the banks, we will see a solid set of numbers, but when you are seeing growth of 4 to 5%, you really don't expect to see double-digit growth in terms of share prices. One thing we'll be watching from the banks, though, is the dividend rise. There's a big expectation that we are going to see an increase in dividends, and not only that, the possibility of special dividends as well. So if we see that come through, we could see an extra boost for the bank's share price.
Mike's
on the 65-cent bid coming through from Wilma and First Pacific is the valuation on a forward enterprise value to EBITDA ratio. That's 6.8 times. Now, that's a very low ball bid, and that's based on an enterprise value of about $1.7 billion for Goodman Fielder and an EBITDA of about $260 million for the next financial year. If you have a look at the agribusiness sector, the deals that have been done over the last 12 months are generally in the range of about 9.5 to 9.7 times multiple. So 6.8 is a very, very low multiple. If we put the Goodman Fielder bid at say the midpoint market, about 9.6 times multiple, that would give it a valuation of $1.01 per share. So you can see why this bid is being called opportunistic at 65 cents per share. Of course, we have seen other bids that have been much higher than this multiple, and the one that comes to mind is the bid for Warrnambool Cheese and Butter, and that was one of the most expensive deals in agribusiness history at about 12.5 times. And I guess the agribusiness sector has been quite hot. What the market's now watching for is whether any other bidders come to the table. They're unlikely to be Australian bidders because the agribusiness sector in Australia is so small. It's less than 1% of the ASX. We'll probably be watching international bidders instead, and we know that there have been a few international agribusinesses active in Australia. Archer Daniel Midlands, which is US-based, Wilma, which of course is Asia-based, and Bright Foods, which is China-based as well. So Goodman Fielder shares doing extremely well, but a very low ball offer coming through from Wilmar and First Pacific. Well, price is the big thing, and we did see iron ore prices back at 111 US a tonne. I think in terms of the actual quarterly production report, it was a good report which came ahead of expectations. 1.22 million tonnes, that's ahead of the estimates for 1.13 million tonnes. And BC Iron is one of these iron ore stocks which has a lot of free cash flow coming through. It's got an extremely strong balance sheet. In fact, if we have a look at the cash balance, it's at about $149 million, and that's after dividends of about $21.1 million have been paid. So a very strong dividend, strong free cash flow. I think the problem here at the moment is the iron ore price, but also what BC Iron is going to do with that cash. Now, they have signalled in the past that they are on the hunt for acquisitions in that Pilbara region, and with the iron ore price at 111 US a tonne, that's probably not going down too well with the market. In fact, investors and shareholders probably want a higher dividend yield instead, and some of that money being returned to shareholders in the environment that we're seeing at the moment. So iron ore prices under pressure, hopes of stimulus disappearing really are impacting on iron ore prices, and as long as we continue to see that iron ore price under 120 US a tonne, I think the market's going to be really cautious around these iron ore stocks.
All right.